China is releasing a series of economic data tonight, 2 days earlier than scheduled. So perhaps the central bank wants to raise rates before markets open on Monday. For more on the subject, we are joined right now by Andy Shia. He is a former chief Asia economist at Morgan Stanley. He's now an independent economist out of Shanghai. Andy joining us on the phone. Andy, always glad to speak with you. Thanks for joining us. We know you probably don't agree with Stephen Green's comment that says that basically there's going to be a low rate of inflation, or rather a low risk of tightening. What if the inflation data does come in higher than expected? Do we see tightening this weekend?
Yeah, I think that inflation right now is pretty high. Its official data are compiled in certain ways. They may not reflect the inflation on the ground, and I think that the inflation expectation is very high, and the government probably needs to do something very soon. Still, the government is not serious about raising interest rate. They still want to engage in psychological warfare. Basically trying to change expectations to cool inflation. So they probably will raise reserve requirement, deposit reserve requirement ratio, or increase the interest rate by 27 basis points. But still, I think compared to the level of inflation, it's not enough at all.
Andy, do you feel sometimes like you're the only one in the world who's worried about inflation in China?
I think that I would say 99% of the people in China are worried about inflation. It's just the people in the financial market are talking differently. I think that I'm not in the minority at all.
What do you think about last week's GDP and inflation data? Did that change your mind at all about what the economic situation is, what the growth outlook is in China?
No, I think that China's problem is not a marginal change like this quarter's growth number or that month's inflation number. The problem arises from 8 years of over 18% money growth. All that money has gone into land market. The land prices are up in over 10 times in the last 8 years. In some provinces, up over 100 times. So that is a leading indicator for inflation, and people see that everything else is going to go up unless the land price comes down. So that's where we are now. It's not about a marginal change; it's about the level.
All right. Now, you have said in the past that you think China will raise rates twice this year, 27 basis points each. Do you think it's going to be enough to stabilize prices? No,
not at all. China's interest rate is at least 3 percentage points below where it should be. Probably a lot more than that. Nominal GDP has been rising at close to 19% per annum for the last 8 years. Now, when Taiwan and Korea went through a similar phase in the 80s, interest rate was like deposit rate was like close to 10%, while China's interest rate now is for 1 year is 2%. So you can see how underpriced the capital is. That's leading to a lot of problems like really land price going up 100 times in some provinces, and capital is so cheap, but everybody wants to build and build and build. So this is sort of it's the distortion in the capital pricing is causing all the problems we're seeing in the Chinese economy.
Andy, we thank you so much for the time. Andy Shia joining us there. He is an independent economist, formerly Morgan Stanley chief Asia economist.